Okay, let's get started. So this session we're going to focus on physical risk. So we're going to particularly look at what do we know, what do we not know? Do we actually have a grasp on what the material financial risks really are? And what are the implications of that? So let me start by introducing our very esteemed panel. So to my right, I have Irene Monasterolo from EDHEC Business School. And then we have Olivier Mahul, practice manager from the World Bank. Tom Perkins from the Bank of England. And definitely not last but not least is Adi Mukherjee from Lloyds Banking Group. So we're going to start with a couple of presentations, around 10 minutes each. And then we're going to move to some opening remarks from our other speakers and then get into the discussion. And I want to leave plenty of time for you to ask lots of questions as well and to engage you all in the discussion. So without further ado, let me introduce Irene.
So thank you so much. It's a pleasure to be here today. Today I'm presenting recent results from our first analysis on asset level climate physical risk assessment and implications for cascading financial losses. In particular, we will discuss about where the problems are in physical risk assessment. So when we want to translate scenarios of acute and chronic risk into economic and financial shocks and evaluate the relevance for individual and financial and systemic financial stability, and what could be done. So first, why this paper? Because there are main gaps in physical risk assessment. We had growing research in the last decade about transition risk. We were discussing also before in the session on stress tests. I myself developed and published in 2017 a climate stress test focusing on transition risk. Nevertheless, we have much less research on climate physical risk. And this is not because it doesn't matter. I mean, you might have all felt it here, and we see a growing need for action. Where are the gaps? First gaps are on scenarios. So we published last year a paper together with Nicola and Olivier about the limits of scenarios for physical risk assessment. So mostly they have only chronic or acute and not both. Then the second issue is about information. We still miss information at plant level, so most information is either poor or proprietary, and it's not standardized. So another major issue is the need for consolidated financial and non-financial information at asset level. And what's still missing also is the translation of asset level shocks into adjustment in financial valuation of the securities related to the assets and financial risk assessment, so metrics of risk for the portfolio of the investor, like climate value at risk or the expected shortfall. Indeed, the issue of poor climate financial risk assessment has been recognized also by the last report of the Intergovernmental Panel on Climate Change, in particular in Chapter 15 on investments and finance, which states that poor climate financial risk assessment hinders capital reallocation to mitigate and adapt to climate change. So, to address these gaps, we developed the first science-based methodology to connect asset-level information with firms' revenues, economic dynamics, financial valuation, and risk at the level of a portfolio of security. Where does risk come from? In our approach, risk emerges from the interplay of chronic and acute shocks on geolocalized assets and firms' revenues from assets across different business lines. The results that you obtain, and I will drive you through in the next slides, is that neglecting asset-level dimension, so the plant localization, activity, relevance for the business revenues, and technology, can lead to large estimation in errors, so potentially large underestimation of losses, and non-coherent investment decision in terms of risk management. Here is the framework. So from the left, we start with the development of a database model to logically connect climate, financial and non-financial information at plant level, so asset type, using only public available information, so information that can be retrieved from Standard & Poor's, Refinitiv, and so on, from which different bits of information for the same plan are standardized. Of course, the analysis can be extended with other databases, such as the database that they are developing at Oxford, and tailored. Then, the database also includes the reconstruction of firms' global ownership chain in order to see the irrelevance of the assets for firms' revenues. There is work of harmonization and standardization. The second step is to do plant-level probabilistic climate risk assessment. In this case, we use Climada, the Climada model, which provides shocks on capital stocks geolocalized in 1 kilometer and focuses on tropical cyclones. The tracks are adjusted for climate impact scenarios, and we use the shocks to develop area and hazard-specific damage functions for physical assets. The shock on fixed capital of the firm is then translated in the third step into macroeconomic impacts at the sector level with an economic model and considering different combination of socioeconomic share pathways and representative concentration pathways, and then in an adjustment in the financial valuation of the contracts issued by the firm which has assets hit by physical risk. To do so, we develop a climate dividend discount model where we shock the long-term growth of dividends of the firm. We do an application of Mexico. Why Mexico? Because Mexico is relevant for cascading economic and financial losses. It's a country which is highly exposed to physical risk, but also where we can find several plants owned by firms which are either Mexican or internationally owned, and that issue securities. In this case, we consider equity holdings. So we have 177 firms, quite 2,000 geolocalized assets, and an exposure of quite $300 billion of European investors to such assets. And we consider shocks coming from tropical cyclones. Here are some results. So how to read the graph? So we have in the figure, you can see 4 corner cases, which are the stream dots, which are synthetic firms, and a selection in the center of firms with geolocalized assets that account for at least 50% of revenues of the firm. So these are the assets that are major contribution to the performance of the firm. On the x-axis, we have the losses on fixed capital of assets, of firms exposed to chronic shocks. And what we see here on the bottom is that chronic impacts on assets are in general very mild. But when we move on the y-axis, we see that the impact on the firms coming from acute shock on physical assets can be as large as over 60%. Finally, the color of the dot. The color of the dot represents the shocks on financial valuations, on the adjustment in the financial valuation of the equity issued by the firm, which has assets exposed to different degrees of acute and chronic shocks. And what we see here is that actually there is an interplay, which is showed by the red arrow, between chronic and acute shocks that leads to higher financial shocks. Here we can name some of these companies to see the differences. First, companies that have large acute shocks, so please see the top dot in the higher part of the figure, which is Silvercorp Metal, which is revenue shares 100% from mining. Acute shocks could be large, even if companies operate in different sectors. Indeed, we can see silver mining, but also on the top right, we have another company, which is Scatec Solar, which has plants from electricity renewables, so solar panels. Second message is that companies can be affected by similar large acute shocks, but can have very different chronic shocks. And both examples we did so far could apply here, because silver corp metal has a very low chronic shock, but Scatec Solar has a larger shock. Companies also can have similar chronic shock because they belong to the same sector, but very different acute shock, and this is due mostly to the geolocalization of the productive plant. And finally, we have a final company which is highly diversified in its revenues composition, which is Tohoku Electric Power. So it has revenue shares from electricity fossil, electricity hydro, which is this one in the middle, renewables, construction and services, which has actually led a large chronic shock which interplay with the acute shock. The plant level information is then used to shock the economic dynamics. However, when we do so, we need to pay attention about which model we use, because macroeconomic models that are traditionally like CG or DSGs, for those who use them, who are familiar with them here, that are traditionally used by central banks, financial supervisors, financial institutions, tend to average the shocks. Why? Because they have representative agents with rational expectations, and they need to have some linearity in order to solve analytically. What we did in this exercise with the European Central Bank is to use another model, the Irene stop flow consistent model, that allows to depart from rational expectations and to have heterogeneous interactive agents with adaptive expectations, and not being bound to solve to linearity, in order to assess the double materiality of the network for green the financial system scenarios in the euro area economy and banking sector. And what we see here, please see the red bar, which is the hothouse world scenario for physical risk, is that by 2050 in Europe, we can have a shock on GDP of close to 14%. This result is larger than what the ECB obtained with using the same scenarios, but also consider that this scenario, the hothouse world scenario, includes only chronic shocks and not acute, meaning that these results are conservative. But still, it's possible, even with the limits of the scenarios that we have, to see larger shocks on GDP. This all depends from the model that you use. And the last message, and then I will close, is that why we need good economic assessment of shocks, because then we want to translate them in adjustment, in financial valuation, and into climate stress test. And in this regard, you talked before about the stress test, considering not only the characteristics of climate shocks, but also the characteristics of finance is fundamental. And for finance, for what we learned from the last financial crisis, is that leverage and interconnectedness matter. And this is what we show in the climate stress test we published in 2017 on nature climate change, for which you can see here two examples, where for some banks that you might know quite well, where the light bars, in particular on the brown side, represent the shocks on the climate value at risk for a portfolio of bank, where the darker bar represents first round losses, so direct exposure, and the second bar represents second round losses, so the losses due to financial interconnectedness. This result shows that banks are heterogeneous in terms of exposure and potential realization of losses, and thus this is why we need to consider financial characteristics and consider interconnectedness as a potential source of risk propagation. Thank you.
Thank you, Anna. So I'm going to allow a quick question of clarification before we move on to the next speaker, but maybe while you're thinking of your question, I could ask you one. So in the last session, we were talking about supervision and stress testing, and talked about how potentially some of the really material financial risks are not being captured right now in the stress tests. So what does your research say about it? So I think my interpretation, particularly your point on the European stress test, and you're showing a shock of 14% compared to what they showed. So are we missing key material financial risks, and what are the implications of that?
So, yeah, we are missing, so all this, it's super, first of all, let me tell that it's super important what the NGFS has done so far, and central banks and financial regulators which moved very fast on climate stress tests, and also development finance institutions, since you worked with the Philippines at the climate stress test there. Doing climate stress tests is important. Knowing the limitations of what we do is even more important when we then come to inform policies, regulation, and investment decision. So which are the limitations here that we face and we need to address are two types: scenarios and shocks until they get to the economy, and how we elaborate them in the economy and finance. For scenarios, let's say, things are moving rather slowly. And of course, it takes time because it's we didn't really were prepared to move so fast in so short time. For the economy and finance, actually, we already have models that can elaborate this, the information we have now and provide some meaningful shocks. This actually is not, so there are already alternatives, at least comparative exercises that can be done. And this is important because otherwise, if I am a financial regulator and I see no economic recession or no large over 3% shock on GDP in 50 years, why should I adjust capital requirements for banks? That's a major problem. And the problem is not that there will not be shocks before 2050. There will be shocks. The problem is that we are not assessing them in the way we should and we could.
Thank you very much. Any quick question of clarification?
Hi, Bridget. I'm just curious, you showed the bank potential loss from banks given these scenarios. I think you mentioned the 14% GDP in 2050, was that the stat I heard? And what is the equivalent, if we were to look at the shock in 2008, 2009, implications not just for the financial services sector, but also... Sorry, y'all. Bridget Fawcett from Citi. I guess my question is, if we take your analysis, and I think you had referenced earlier the 2009 situation, a parallel situation for the financial services sector, and you showed the banks, what's the corresponding implication for GDP? Did you say 14% potential decline in GDP, and also what is the valuation implication? So we're looking at banks here, but what about asset owners and managers?
So thank you for your question, because this is actually very, very relevant. Well, it's not that after the last financial crisis, financial interconnectedness declined so much. Actually, we know that it even increased. It's true that banks, capital requirements for banks adjustments, so there is a leverage of 33. Is this enough? Maybe not, because if you have a mispricing on less than 5% of your portfolio, then you might already bump up. So this is what 33 means. Also, when we had the last financial crisis, we didn't consider climate. And climate is a very different type of risk because it's forward-looking, so we cannot get it from past market prices. That's what could happen.
But if you were to extrapolate this, sorry. I guess my question though is, I understand we weren't looking at climate during that crisis, but there was fallout more broadly than the firms that you have listed here to the economy. And I guess I'm just wondering, have you modeled what the broader implication is for a downside scenario according to these stress tests for the broader...
we are working on that, right?
You.
And it should be out in terms of implications for capital requirements and prudential regulation the next season.
Thank you. So thank you so much, Irene. Take a seat. So now, Olivier, to you to tell us about how the World Bank is thinking about these questions.
Yes. Okay, wonderful. Great, thank you. Thanks first of all for the invite. Very pleased to be here in this panel. So look, tough to talk about after Irene. I mean, given the level of sophistication of our model, allow me to take a step back and maybe to go back to the basics, particularly from the bank perspective, where we're dealing a lot with emerging markets and developing economies. And this topic is, of course, quite new for them. So I'm going to try to explain how we engage with them, the process, which is sometimes as important as the result, and to go maybe beyond the kind of stress testing type of approach, but really talking about climate risk analysis and how and what we can do to some extent to work toward our own objective, which is really to try to promote growth and to eradicate extreme poverty. And of course, in that context, the impact of climate is quite important. As you may know, the World Bank has developed a new series of diagnostic tools called CCDRs, Country Climate Development Reports, which are aimed to inform our dialogue with the countries moving forward, not only, of course, on financial issues, but on the broader impact on the economy and, of course, the livelihood of people. So the financial sector, of course, has a major role to play. And the way we've been trying to articulate that through some sort of a framework within the finance group of the World Bank, when we talk about finance for green and resilient growth, is to focus on three key buckets. One is about disclosure and reporting, around taxonomy and reporting standards. The second one is really about risk management, and I will focus particularly on that today, including new instruments or opportunities to protect households, businesses, governments against shocks, but also all the prudential regulations, including stress testing, which goes with that. And green finance, of course, again, which is just to highlight, the investments we can and how we can, to some extent, promote those investments for low carbon investments as well as resilient investments. And we do have a set of tools within the World Bank to support that, including analytical and advisory services. We're trying to contribute as much as we can to global discussions. Of course, the NGFS is one of them. And also, we do have some lending tools to some extent to accompany countries when they move into policy reform, because ultimately, this is what we aim to do, to help them, make, I would say, relevant reforms and to try to accompany them in their process. So, when it comes to climate or physical climate risks and their financial shocks, and Irene, you already mentioned this work we did together with Nicola and Irene. First of all, we try to better understand how to build some scenarios. Of course, on building on the existing literature, and the NGFS is a good starting point. And particularly in this paper, we've tried to identify some key risk drivers that make this kind of material contribution even more important. One is about extreme weather events, and I will focus particularly on that, how we can better plug extreme events in those scenarios. And there was a discussion in the previous session about, working around the mean and also to try to go beyond the kind of mean or the average values, particularly when it comes to chronic and acute risks. To very much focus on uncertainty, and I will talk a lot about that. All the uncertainty around that, I think, is quite important, and even more so in less advanced economies where access to data is a problem. So again, it makes those risks those uncertainties even more acute and even more important. Compound scenarios. Again, we talked a lot about climate, but of course, in the current, I would say, environment, even more so those days, it's important to have kind of more holistic approach. Ultimately, this is what the governments are asking for. I mean, they don't plan to, I would say, focus only on climate, only on pandemic, or only on the food crisis. It's really a kind of mix of that, and how these risks can compound together. And then the indirect economic impact, and you really mentioned that in the context of Mexico. And also, very important, the kind of feedback between the real economy and the financial economy. So financial sector and the economy. So again, a lot of, I would say, issues, a lot of questions, and of course, at least being aware of them also help us navigate and also identify priorities with our clients, our countries. So let me, again, as I said, I'm going to start with the basics. So when we started thinking from this perspective at the bank, knowing the kind of range of potential counterparts we have, when we talk with the Central Bank of West Africa, it's very difficult dialogue and very difficult and different dialogue than if you talk with a much more advanced central bank. So the idea was truly to try to identify some key steps in order to guide them into a kind of meaningful dialogue. And this is why I said the process in this case is as important, if not more important, than the result itself. So we came up with a pretty simple, what we call practical framework, again, to be able to focus particularly on acute physical climate risk and to engage on this dialogue in countries where this dialogue is non-existent, and to make it as meaningful as possible, and particularly help them prioritize that compared to many other priorities they may have on the financial sector. So again, this is also a kind of a dialogue to find on the right entry point. So there are some key lessons we drew from that, and I'll go through them in a few minutes. So one example, I'm going to just highlight 3 examples to show you the kind of diversity of the dialogue we're having. So one is the work we've been doing with the Central Bank of Morocco, where we took, in fact, the NGFS scenarios, and we tried to add on those scenarios some extreme events related to drought, because drought, of course, is a big risk in Morocco, as well as floods. And through this process, building on past work with them, we've been able, to some extent, to come up with the scenarios and then identify the potential economic and financial impact on that. So work is still in progress. Of course, to be discussed with the central bank, so I cannot really share numbers, but fundamentally what I want to say is, again, the process to try to engage with the central bank was quite important, just to define the kind of relevant scenarios. So a lot of work has been put here to work with them and identify those scenarios in terms of prolonged droughts or in terms of floods. And of course, these are extreme events from their perspective, and then the idea again is to see what will be the potential impact on the economy. So, interestingly, of course, when you have those scenarios, you can plug them into different models. So one, of course, is the Irene model, and we've been working with Irene's team to come up with some results. We've been also using some OECD model, again, to see how these models, how these shocks can affect the economy, and also we've been using our own World Bank macro model. And of course, those models will come with very different results, one source of uncertainty. So again, how you, to some extent, balance those results, and again, hopefully to have a kind of meaningful conversation with the central bank. Another example, which is interesting, although not maybe representative to the level of sophistication sometimes we have with our clients, is the work done in the Philippines. And Nicola was very much involved in this work, which was part of what we call the Financial Sector Assessment Program. It's a joint World Bank IMF program which aims to identify potential, to review, in fact, the financial sector, both from a kind of stability perspective as well as development perspective. And you can see on this slide some of the kind of results of the climate change stress test. And of course, Nicola, feel free to elaborate later on that one. But again, fundamentally, what was interesting is that without other shocks, as mentioned on this slide, the impact on typhoon winds is very limited. Now, when you combine this shock with other shocks like pandemics, the risk becomes more significant. Does it mean that we should ignore that? No, there may be many other reasons. First of all, we focus only on climate, on typhoons. The transmission channels can also be questioned, so a lot of uncertainty. But fundamentally, when you look at the results, there is a materiality. Is there a risk for systemic risk? Is there a systemic risk? Again, this can be questioned, at least in those scenarios, under all these kind of assumptions. Another interesting example is the work we've been doing, and we're doing, in fact, in Vietnam. Very similar work, we're trying particularly to focus on the impact of physical risk on the non-performing loans. So, same process. We're trying to identify with the central bank in Vietnam key scenarios that make sense for them, and then we plug that into some macroeconomic model and try to estimate the impact in terms of GDP, the economic impact, as well as the impact on the banking sector. And again, on average, those numbers are not very large, particularly focused on the direct impact. If you start adding, of course, the indirect impact, the numbers can be much larger. And again, just having this kind of dialogue with the clients at least help, sensitize about the problem and ultimately come up with more sophisticated work. Again, process is as important as the ultimate result. Let me draw maybe some key lessons learned, which again, for most of you may look obvious, maybe a bit too simplistic, but again, in the context of our work, is quite important to keep in mind when engage with partners. Sorry, don't want to break anything. So the first one is about the need to clearly identify the objectives of your local stakeholders. When you engage with the central bank, the objective is to be defined. And again, there is a lot of discussion to clearly identify what they want to look for. What is the question that we're trying to answer? So, particularly when we talk about central banks versus if we were to talk, for example, with Minister of Finance. The data granularity and coverage is quite critical. Again, to try to identify the right data in order to have meaningful results. Doesn't mean that we can go at the asset level. Maybe it's not necessary for first dialogue with the client, but at least having the right level of granularity to come up with some meaningful results. The scope of the analysis is also quite important. We need to start from somewhere and we need to prioritize. And again, this is not an easy process when you have a client who is not always very clear on what they want to do and what we can do with them given the data and sometimes the lack of data. Scenario analysis, there are multiple scenarios that could be designed. What are the key ones which are important for them, or where we need to focus first, at least in the first phase? So again, this kind of dialogue is quite important when we work on that one. In a country where drought is important, let's focus on agricultural sector. But sometimes the agricultural sector is not very much represented in the banking sector simply because access to finance for farmers is very limited. So you need to take into account this kind of country context to really have some interesting results at the end. Quantitative analysis, and we talked a lot about that here, is important. Qualitative analysis in many countries where we work is also very important. When you start a dialogue in Africa, this kind of qualitative dialogue, I would say, is even more important than the quantitative dialogue. So again, this is a mix of both, but definitely we put a lot of emphasis on having a proper qualitative dialogue before we can move, when we can, on a more quantitative analysis with all the caveats, and this is my last point, related to the model we're using, the assumptions, the data, and all the uncertainty. So if I were to summarize maybe in 4 words, and this is what I will leave with you today. From my perspective, or from our perspective, this work is about materiality versus systemic risk. It's about heterogeneity. Some of the results at the macro level may not seem quite important, but when you dig down, when you go deeper at the bank level or at the sector level, then the numbers can be much more meaningful and much more significant. Granularity, it's all about finding the right data and the right level of data. It doesn't make sense when we engage in a country to start at the asset level, for example. So what is the right approach to some extent to go deep on a kind of structured way, still having a kind of meaningful dialogue with our clients. And last but not least is about uncertainty. The level of uncertainty is very important. When you have counterparts who may not be as educated as in other countries or are as sophisticated in terms of their comprehension of the problem, it's important to clearly identify and flag the uncertainty. Doesn't mean that the results we can provide are meaningless, but at least it's important that we clearly qualify them and make sure that they understand that they are a set of results to drive the discussion, but definitely not the only result they should take into account. I will leave you with that. Thank you.
Thank you. I want to ask you a quick question before you escape, which is So I think one of the things many things I recall sort of working in emerging economies on these issues. Some of the key issues that come up can be very different. So, for example, Morocco. One of the interesting things is that they had a very big drought back in the 80s, and it had a really big impact on the financial sector. And as a result of that, actually banks were very aware of physical climate risks. And also there was a large guarantee. So the Ministry of Finance was holding a guarantee for the banks to deal with this risk. So actually it meant that the government itself is holding a lot of risk. So do you have any reflections on, most of us are used to working in high-income countries, and there's now 100 members of the NGFS. What different types of issues do you hear from emerging and developing economies?
I think several questions in your question, but on the NGFS one, the kind of feedback we've got is again, the entry point can be quite different between more advanced economies and maybe slightly less advanced economies. the scenarios have to be very much designed to their needs. The physical risk component, which I think we all agree is slightly less developed than the transition risk component, is quite important for them, but not in 5 or 10 year time, it's next year. So how can you better capture this kind of short-term extreme events that can impact their economy tomorrow? And again, it's because it's not only it's important for the central bank, but also for the Ministry of Finance and the government, because it does create additional contingent liability for the government. Some countries have been, I would say, wise enough to set up some guarantee schemes. Many of them are not. So then, of course, this has major impact on the real economy. So this is what we need to balance, making those scenarios again much more country-specific and coming up with some results which are again as robust as possible, maybe not as precise as possible, but very robust. And again, as I said, the process leading to those results is as important as the result itself. So if you come up with a black box, like in any country, I think it makes the dialogue much more difficult. So it's important to be very open and to go step by step with them and focus on the process more than the results themselves.
Thank you. If it's a quick question, because I need to move to the next speaker.
I can save it, but maybe just for the sorry, just a question for the panel, and maybe for the end to answer, is the pivot of physical climate risk and transition risk, and how those Venn diagrams meet, and the view from a country lens, which you were just addressing, versus an industry lens, and where does that risk reside? We can come back to it.
Think about that and we'll come back to it.
Thank you. Give me one.
So Adi, I want to come to you now as one of the people that's managing these risks as a practitioner in a bank. And I know you've also had experience in a former role in emerging economies as well. So I'd love your view on this.
Yeah, allegedly. So my name is Adi Mukherjee. Oh, that's loud. So I was heading up climate risk at Standard Chartered, which was a very emerging markets focused bank, but headquartered in London. Moved recently to Lloyds Banking Group, which is a very, very UK-focused bank. So completely different business models, different challenges, I guess. So before I kind of start my speech, I think a lot of the fellow speakers already spoke about, so there's two key words kind of come up again and again. So there's one around uncertainty and one around rationality. So we sort of, most of these models, as I understand, obviously Irene and Nicola would understand these a lot better than I do, kind of have an inbuilt assumption of rationality in response. Just to test that, can I just check a bit of show of hands? How many of us in the room here sort of live in the UK or Western Europe, Northern Hemisphere? Okay, most of us. How many of us have got air cons in their house? 2 or 3. So, oh, sorry, 4, 5, there we go. That's, so, I mean, it's, I don't know, it's what, 5%, maybe less than that? Maybe more, 7%, let's say, to be accurate. Do you think that's a rational response? Okay, let me ask one more question. How many of us in the room believe in climate change? So let's play this out, right? Let this sink in. All of us believe in, by the way, I also believe in climate change. All of us believe in climate change. All of us have seen the projections. All of us have just experienced the heat wave. The rational response, according to me at least, would be to have aircon in your houses. And we probably think we are rational beings, and we probably are, but that's not what we are doing. So rationality kind of does not necessarily work in a specified point-in-time basis. It works over time, maybe, but definitely not point-in-time. So something to keep in mind. The other one that we refer to quite a lot in my job and otherwise is the uncertainty element. And I have a bit of a polite challenge to that, because a lot of the, so there's two uncertainties, right? How high the temperature will go versus stay low. The uncertainty on the top end, so is it going to be 4 degrees or 6.5 degrees, is almost irrelevant. When I say irrelevant, it is catastrophic, don't get me wrong. I say irrelevant because even at 4 degrees, it is already catastrophic. So 4 to 6.5 degrees is not really that much additional devastation as it is between 1.5 to 4. There is no uncertainty. So I think the fellow speaker on the panel before me was talking about litigation, mentioned this line which stuck with me, which was, bankers cannot predict the interest rate in 6 months, as well as temperature can be predicted in the next I mean, he said 6 months, but I said 10 to 20 years. Because these are actually quite stable trends. If they do worsen, the uncertainty is actually on the downside or the upside in terms of temperature. It could be higher than we're predicting, definitely not lower as we are seeing things. So the uncertainty is more on the space of transition, and I'll come into transition risk in a second. It's not so much on the physical risk side of things. That is pretty much well understood, if anything understated. The third element, which again has been touched on quite a fair bit, and that's where I'll spend most of my 6 minutes on, is humility. So I think there is a huge amount that we don't know around physical risks, including the modeling, the quantification, the use of it, the transmission channels, how it makes us lose money, which is very, very important for us to recognize, as people who look at these risks in our jobs, but also collectively as a society. The reason, as I'll give you an example, let's take mortgages. So if any of you work in a retail bank, you probably have got exposure to residential mortgages. Lloyds banking group certainly does. We're the largest mortgage provider in the UK. And my previous employer also obviously had mortgages, but more in the emerging markets. So when we look at physical risk impact on mortgages, and it's a very tangible, perhaps a bit tactical example, but bear with me. We look at the asset level data, as we were talking about. So we look at the exact location of the house. We see how much is the, so there are models like Climata, there's proprietary models, public models, which would tell you that if your house is located at that latitude, longitude, this is the level of physical risk. Then we either model something around what is the impact to valuation of the property because of that severity of physical risk, or we assume that's going to be 10% at a certain level, and then we calculate the losses, the expected or the unexpected losses that come out of that using set formula and models that exist. There's a big missing component in here. The human response is to save your mortgage first and then pay your unsecured bills. So what happens is the data that one bank has is on our mortgages. So we know how much, if you have a mortgage with us, we know your exposure there. We don't have data around what mortgages you hold elsewhere with other banks. And you may not have only mortgage with one bank. There's a huge systemic impact around, so if physical risks start materializing, even if it's not directly on our mortgage portfolio, we quantify a certain amount of loss. It could be because of that cross-product holding, a huge loss starts coming through the unsecured lending side, which is not really talked about at all from a prioritization point of view. So similarly on the corporate side, I guess on the asset level data, so if you think about asset level data is definitely the right place to start, I would say, because that starts becoming granular and focused and specific. But a lot of these risks will sit on their supply chains. So you might think of a company, map out all their assets. Obviously, if you think of a bank, it's not a good example, but for a bank, the offices might be exposed to physical risk, may not be exposed to physical risk. It doesn't really mean anything. It comes from the clients. So even if you look at a client, it's the supply chain from the downstream to upstream. So let's say you're a ice cream manufacturer based somewhere in the Midlands. You manufacture your ice cream, but the market that you sell it to is, say, south of England. So if you do an asset level analysis on the company, you'll say that actually, that's okay because it's Midlands, and let's for a second assume that Midlands doesn't have a lot of physical risk. So that company is okay from a physical risk perspective. It's actually not, because this market is in the south of England, and if that gets flooded or goes through heat stress, it's a huge financial impact to the company. So we should not quantifying these and making this better is what we can do as a society, and work collaboratively across institutions, with the regulators, with the academics, insurers, all actors in the society in that sense. But we should also keep in mind that all of these are, if anything, the right thing to do, but they're probably understating the actual losses that sit with physical risk systemically for one bank and obviously across the financial spectrum. So just maybe touch on one other thing before I probably hand over to Tom. So I think the Bank of England, which is sort of been my principal regulator, because I've worked across HSBC, Standard Chartered, and Lloyds now. So I think, the Bank of England carried out an exercise called the Climate Biennial Exploratory Scenario. Started off in 2019, but COVID hit, so it got delayed a bit, which I thought personally, I've had the distinct pleasure of having seen this in two banks. I've seen it in StanChart, I was kind of accountable for delivering it, and I've seen it in Lloyds Banking Group after joining it. So different approaches, different lenses to put on. But what I have seen across the two banks is this has been a brilliant exercise where the regulators sort of came and said, let's learn together, which was absolutely crucial. The industry got together, obviously not breaching any anti-competition laws, but exchanging ideas, views. The Climate Financial Risk Forum was created jointly by the PRA and the FCA, of which I've had the honor to contribute to over the years. And one of the things that we are looking at as part of the scenario analysis working group this year under the Climate Financial Risk Forum is to bring a bit more focus to this physical risk angle. Because it is a lot, Nicola and I were discussing this before, it's a lot cooler to talk about transition finance, sustainability-linked loans, have targets, 5 billion, 1 trillion, 100 billion, because that is the positive story. The unfortunate reality, and particularly working in a risk function, the unfortunate reality for me is that we hope for the best, but you prepare for the worst. That adaptation is basically a real need of the hour to start looking into with a lot more focus and a lot more humility, and I guess a lot more seriousness. So I'll probably leave it there.
Thank you very much, Adi. So I'm going to come back and ask questions about adaptation, but I'm going to first come to Tom to give a perspective from the Bank of England.
Thanks very much, Nicola, and hi everyone. So just to give some context, my role at the Bank of England is in insurance supervision. So my background is catastrophe and climate analytics. So hopefully through the next few minutes, I'll give some food for thought to then lead into a bit of Q&A. So who here cares about 2040? I think it's fair to say we all do to an extent, but as has been addressed here, 2040 feels a long way away in a lot of respects. But I think it's an interesting point to start on because if we think of 2 years ago, a few of you may recall that the Met Office released a spoof weather forecast for 2040, or it might have been 2050 even. And if anyone recalls it, it's a sea of red with temperatures unthinkable in the low 40s, very similar to the forecast that we saw on Monday. Why is that relevant here? Well, that highlights the lack of context we often have when thinking about the uncertainty of future climate scenarios. It might feel like something very distant, but it's actually very relevant to today when we consider how uncertain our risk models are for the present. To give another way of thinking about it, if we think of a 1.5 degree scenario and say a 4 degree scenario, yes, they're very different, but if we look at the 95th percentile on most, certainly physical risk projections, there's quite a lot of overlap. So again, it just highlights why it's relevant to be thinking on these timescales. Which brings me on nicely, hopefully, to CBES, the Climate Biennial Exploratory Scenario, as we've touched upon already. And hopefully the purpose and the objectives of that, which I appreciate many of you will already be aware of, was a lot to do with capacity building. And as we heard from an earlier session from CGFI and other studies, the reception is that it did encourage that capacity building. But that's fair to say that's not where it ends. It was very much an exploratory scenario to consider what might happen or how we can better improve in the future. So that's nicely feeds us into this session, which considers physical risks and the cascading risks associated to that, as well as compound risks. So that's something I want to go into a bit more detail, but just to briefly mention a bit about CBES, because I appreciate very much flavour of the month. So I think some of the headline findings we found from the Bank of England's analysis was that the main differential in the results that were submitted were nothing to do with exposure, all to do with methodology. It was how well were firms able to match direct physical variables, which were benchmarks that we released as part of the physical scenarios. And the limitations there included a lot of models being black boxes. Then secondly, in terms of what we would then observe is the importance of that bridge, as we've come to call it, between the climate model output, which has its own inherent uncertainties, and then the catastrophe models and other methods of risk quantification within the financial industry. And one thing CBES has highlighted is the challenge of bridging between those two, but with successes as well. If we consider some of the ways that CBES highlighted risks to UK banks and insurers, some of the principal risks, certainly from a general insurance perspective, was UK tropical cyclone and UK flood. So a good reason why there's been a lot of detail, in particular in those two, which you can read up more on in the reports that have been written and published. Just thinking, though, about US tropical cyclone, because I think it therefore paints quite a nice picture of where we stand. What we saw with firm submissions is that part of the variety, again, as I said, in one sense was to do with matching to calibrated variables, but the other was actually what risks are being considered. Because if we think of a hurricane, the first mental image is probably of the big storm and the winds. But in fact, what we've seen from hurricanes in the last 20 years is typically that's only one component. It might be the biggest component in most cases. But we'll also see hurricane-induced precipitation, we'll also see storm surge, amongst potentially other factors. And so it's that compound risk that it's now insurers realise is really important to quantify. So to come back to CBES, that's where we saw a lot of variety. It's whether or not some of these additional perils were considered within a hurricane scenario. And that's actually really important if we're considering systemic risk. If we take Hurricane Sandy in 2012, which hit a large area of the US, including New York and New York State, we can notice there that not only was the actual effect of the hurricane itself, there was snowfall associated to the event, but from the compounding factor of an Arctic flow of cold air. So immediately you've got more risk, but then the fact it hit New York meant that there was then cascading impacts to the whole wider economy in terms of affecting the New York Stock Exchange and other financial institutions, and also the power industry from industrial facilities. So immediately, what would seem from a simple catastrophe model that we might run from, or an insurer might run to work out their exposure, a sea of other entities and dynamics need to be considered. And an additional point I'll just bring from earlier is that actually Hurricane Sandy, as was pointed out in a previous presentation on biodiversity, in fact could have been a lot worse if it had not been for the wetlands that protected a lot of the areas. And again, that's not something that would typically be included in a risk model. So we've got a lot to work on, it's fair to say. And with that, it's clearly no coincidence that it's a challenge to be hiring any climate modelers in the industry at the moment. And so really to summarise what we're feeding back to firms, it really is that acknowledgement that we do need more expertise internal within the financial industry, within firms, as well as access to better data where possible at a more granular level to then be able to better quantify the risk. The last point I'll make, which is maybe slightly more to the side, but is a consideration about, are we even being democratic in what we're trying to model? What do I mean by that? It's almost an ethical point in as much as some risks get reported about and measured a lot more than others. In Nepal, the most mortalities from natural disasters comes from landslides. And yet in a lot of catastrophe models and insured loss estimates, landslides isn't actually even included within loss estimates. If we take the Honshu earthquake in Japan recently, it was only the ground shaking and liquefaction that was taken into account for insured loss, not landslides. And indeed, the recent tragic events, I think it was last year, from a glacier collapsing can't really be attributed to an extreme weather event. It's more a culmination of a long-term issue of the glacier being destabilized by climate change. But that's certainly not something that would inherently, again, appear in one of our typical risk models. So, in summary, to hopefully be very consistent with some of the other discussions on the panel, it really is that uncertainty and confidence intervals that we really need to be investing a bit more of our time in, it would seem. So yeah, I hope that invites some questions, and I'll pass back over to Nicola.
Thank you so much, Tom. So what I think, I'm going to invite you all to ask some questions. We've got about 15 minutes left, so do get your questions in. But while you're thinking of your questions, I wanted to just sort of put one to all our panelists or those who want to respond. But first, just a point on that sort of social risk side. So I think that's a really interesting point. And actually, when I speak to pensions funds about physical risks, they seem much more attuned to the social risk side, actually, than talking to banks. And I think one of the key things, I think you're right, Tom, is that we're tending to focus on those risks that are easily translatable into an economic risk and a financial risk. But actually, some of these broader social risks will actually potentially, if not addressed, translate into really big financial and economic risks down the line. So I think that's a really, really important point. As I said, the pensions funds that I've spoke to seem to get this, but I've not heard it from others so far. But so my question I was going to put to you so a couple of the speakers have mentioned cascading risks and compounding risks. And so we've had a lot of cascading and compounding risks in the last couple of years. Those words have become common language that we're using. What have we learned, of anything, from the current crises? So the current food crises, the shocks that's creating, COVID, has that taught us anything about financial risks related to the physical risk side? How is it sort of translating into your own work? But maybe I can sort of start with our first speakers to give a perspective on that, and then to the other side. Olivier.
Yeah, I mean, let me first comment on your social risk. I think it's a very important point. Again, in developing economies, the impact of climate risk on migration, on displacement, is major. And we go beyond, social risk. I mean, can cause war on major issues. So this is something definitely to take into account. Whether we capture that properly, I'm not so sure. There is definitely some sort of awareness, but how we can handle that is quite significant. So I fully agree on your point of social risk, even more important in the context of developing economies. Compound shocks. Look, I mean, just look around those days, all these kind of risks we're facing. Maybe to be a bit provocative, I think one of the challenges is to make sure that, we don't force, at least governments, to pick one risk among the others. I think they all have to be taken into account together. And sometimes, you deal with emergencies, so you're going to focus on your immediate risks. It was climate last year. Of course, Ukraine came, and now it's a different discussion. And you can see that, in the G7 agenda or G20 agenda. So I think one of the challenges is to make sure that, not that we should not prioritize, but it should be seen in a kind of holistic way. So just to make sure that, they have in mind that it cannot be taken one by one, but this kind of holistic approach is quite important because the compounding shock is important. And again, if I refer to the paper we had together, Nicola and Irene, this kind of multiplier can be quite significant and can definitely cause major challenges. So the more we can demonstrate that, and the more we can demonstrate that they are all interrelated, of course, the better it will be. But of course, a very difficult question, how you implement that in policy decisions.
Maybe I can build on this. To work with Olivier and Nicola, right, on the compound risk project that we did the World Bank for over 2 years. Yeah. What was, I was involved in dealing with the macro financial assessment of what happens when shocks of different nature, like COVID, so pandemics, and climate physical risk enter in the economy, and how they cascade in across agents and sectors and affect balance sheet of financial institutions. Well, the point there, that we have two major lessons, I think. The first is that actually when shocks compound, the implications could be much longer and worse than we think, because it's not just that the losses result from the sum of 1 plus 1 shock, but when shocks compound, actually there are, sometimes they self-reinforce each other's, meaning that at the end, the impact in the economy gets amplified. And this means larger, more persistent losses, and this in turn has important implications for fiscal and financial risk management at the policy level. So if we just consider shocks individually, like, sorry to say, as we are seeing right now in the response, at least in the European Union, to the current crisis, we risk just to miss the big elephant in the room, the fact that the shocks, we are preparing to manage shock in GDP, which, and even just referring to GDP, that is much, whose estimates is lower than what it might really be. And the second implication is that these different shocks have different entry points in the economy and different transmission channels, and thus require actually different measures to be mitigated. And this is understanding the nature and transmission channels of these shocks is then fundamental in order to properly address them.
Shall we open up to questions? Let others have a question? Or so we had a question from the lady previously about transition versus physical risk. So let's put that one into the mix, but I'll take a couple more. Mike?
I'd just like to pick up on those wise comments about shocks, which is a word economists sometimes use for things they can't explain ex post. And I'm going to phrase this as a bridging question, I think, to Tom. So let us assume an 8-year time horizon, we get lots of cascading risks that crystallize. There is clearly a possibility that financial markets react and have some sort of fairly significant downward movement, Minsky moment if you wish. That is clearly non-zero. My understanding of NGF scenarios, CBES, is the probability of that is specified as pretty close to zero. So the question is, with your catastrophe experience, what is your probability estimate of a financial Minsky moment in the next 8 years? And whatever the answer, how do you translate that across to the CBES folk, who I think have it currently set at pretty close to zero?
Take one more question. I think maybe.
Yep. Flavio De Carolis from Maastricht University here. I have a question on uncertainty, which seems to be a topic which all of you mentioned. So there is a probability of 80% that we will have ice-free Arctic by the mid-2030s, which is one of the main tipping points that we might encounter in the next years. So I wanted to understand how good are we right now to model the impact that such tipping points will have on the occurrence and the magnitude of physical shocks in the next years. Thank you.
Thank you. So we've got a question on Minsky moments, a question on transition and physical risk and how they come together, and on how will we understand tipping points. Who would like to start?
Happy to kick off on, to pick up on a couple of those. So maybe thinking first about the Minsky moment, and maybe more broadly tying that into any sort of catastrophic, to use slightly the wrong word, but event where there's a sudden change, so tipping points as well. I think in terms of how we model that, it's not something that it's easy to put a number on, in as much as saying, yes, this is what we can be confident of happening. I think there's a lot to be said, though, for saying, okay, well, what if it does? Let's say it does happen in the next however many years. What would the impacts be there? How can we best understand what that chain of events would look like? And I think that's certainly something that would be interesting to explore further. I think from the point of view of the Bank of England's timelines for considering these sorts of next steps of complexity, to plug it slightly, the capital and climate, or climate and Capital conference that's been organised in October is certainly framing to explore those sorts of questions and consider where a regulator and supervisors sit within that in answering those sort of questions, but also more broadly from the market's point of view. Maybe just to touch on where physical and transition risks reside as well, to explore that one as well. I think the main thing I would maybe argue there is that more than anything, it's the intertwining and interdependence now that we're seeing between a physical, a transition risk, and also between different, say, jurisdictions. If we think of Ukraine, to take an example, not that it's a physical risk per se, I think certainly in the past we wouldn't have expected anything in Ukraine to have a notable impact here in the UK. Certainly if we went back a few hundred years, that probably was true. And equally from a prudential risk perspective, it's interesting now to see the increasing focus on cyber risks. Again, because if we think of where a lot of our economy sits, if you look at the S&P 500 now compared to a few decades ago, that is a reflection of where a lot of the risk resides. And so it maybe shouldn't be surprising that we have that greater interdependence and almost vulnerability globally. So hopefully that touches on a few of those points.
I might just quickly build on. So to one bit was on the COVID point, I think supply chain risk is the main thing for me. And the fact that some of these extremely unlikely, highly unlikely but plausible scenarios that we've been using in our ICAPs and solvency stress tests are actually they're not impossible, they do happen. On the transition and physical point, I think my personal reflection is an orderly transition is, and excuse the pun, probably going to be a net zero game. So you're going to have some losers, you're going to have some winners, the economy itself will balance itself out. If it's a disorderly transition, there is a risk of a net loss, because you might have a disruption to the market, but financial markets on the trading side will adjust quite quickly, and debt markets and lending will follow through. So although most banks right now are probably, I think it's fair to say, most banks at this point are more worried about transition risk, also looking at their net zero alignment and transition financing, as we keep coming back to, and having those targets, having the right people, right understanding the products, investing in the right technologies, and so on and so forth. I think if we believe in an orderly transition as the most likely outcome from here on in, it's probably going to be net zero financially. There is no net zero in physical risk. So there's obviously no climate net zero in physical risk, but there is no financial net zero in physical risk. There is no recovery coming out from that shock to the system. So again, if we try to get to the full expanse of it, we have to talk, I think Seabass did touch on this, Tom did, that there's mass migration to consider in physical risk. That will impact the UK and Europe and the US and everything else. Immigration system, healthcare systems, education, much more than what we are probably at the moment estimating through, impact in GDPs and the likes. So I think, which is why personally I think it is probably fair to make that attempt to a net zero transition with our full force of the financial services industry and the real economy. But again, hope for the best, prepare for the worst would be my personal sense.
So I want to bring two more very quick questions, and then we have to close. I think, Tom, you had a hand up, and then...
Thank you, Nicola. So I had a quick question for Irene. So basically, lawyers are really concerned about the responsibilities of boards of banks, for example, and also insurance companies. And that's because regulators are increasingly, particularly in the EU, are increasingly asking these boards to put in place risk management frameworks that take account of climate risk, which sounds like a very sensible thing to do. But particularly because these obligations extend to pricing decisions, it becomes very, very contingent on the model and the scenario that's being used. And I think, personally, that's a huge practical problem. And boards are very worried because if they pick the wrong model or they pick the wrong scenario, they might be exposed to liability ex post once it turned out that they were wrong. And so, based on your findings, I'm more worried now than I already was about this. What would you say to regulators to help them understand the issues that you've just covered?
Can you take the final, was still a hand at the back? Yep. When the lawyers are getting worried, we know it's getting serious.
Hi. I just wanted to make a couple of comments really about these models because the IPCC process in itself is a highly political process with national governments lobbying for the removal of phase down coal, phase out coal in the case of India and Australia and Japan. Saudi Arabia saying, you know, we don't need to get rid of oil, and even Norway saying, oh no, carbon capture and storage is going to be a great thing in the future. So I'm nervous about the IPCC scenarios being sort of taken as items of faith because they are very high quality academic data from very good scientists. But just because 9 scientists say this thing is going to happen and the 10th says that thing is going to happen doesn't mean that the 10th person is wrong. And I just wanted to come back on one of the comments around, it doesn't matter if it's 4 degrees or 6. We know it matters if it's 1.5 degrees or 2. We've had the report on that. They did that in 2018. So we know that it matters. We know that every fraction of a degree really matters. The good news is we don't think we're going to get to 6. We think it's now going to be 4. The bad news is that the impacts on our climate and on our physical systems are worse at lower temperatures because we're all just in the weeds trying to make sense of it. So none of these are predictions. They're just best available forecasts. And they're based on historic data. So the last 2 years of glacier melting from the Arctic are not included in the assessment report that's going to be published in September. And I just think getting some clarity around the science and some of the uncertainties is really important in this debate.
Can I just quickly reflect, because this can spiral out of control very quickly.
I will top up on you. Go on.
I do need to clarify my comment. I think I tried to do that between the 4 and the 6. I'm not saying for a second that it doesn't matter whether they get to 6. The spirit of my comment, which I clearly did not articulate very well, is that 1.5 to 2, 1.5 itself is pretty bad. 1.5 to 2 is very significant. 1.5 to 2 to 4 is absolutely catastrophic. So if we are thinking of the additional uncertainty that 4 to 6 would bring, at that point we are already talking complete devastation. So the economy would be more sensitive. So if you take out 95% of the world GDP, there's only 5% left to play with, so that 4 to 6 wouldn't really matter that much in that context. So I'm not at all arguing for 6. What I'm saying is we must try to make sure that it sort of stay at the 1.5 to 2 degrees. But the uncertainty, if you think of what is the uncertain part, and I actually agree with your point. So the uncertainty is around whether we get to 1.5 or 2. There is, to your point, based on observed data, the projections are kind of showing BAU is 3.5 to 4. So there is very little. So if we did not do the transition side of things, actually we have pure certainty that it will be 3.5 to 4. The uncertainty is that could it be 6? And at that point, we're talking 95 GDP to 5% GDP left. So just to qualify that comment. Thank you.
So,
maybe I would just...
But then we need to close quickly, so I'm going to allow the others to make a quick 20-second final comment. You go first again.
So first, on the 4 degrees, so let's say that we're not so confident to assign probabilities to realization of scenarios, and the point is that there is still so much we don't know about how, for instance, oceans are warming and what will happen in that result. So I would not say, okay, a 3 scenario is feasible as some research highlights, so that's maybe not. Every process is highly political, and yet we should also start read what are the messages that speak out from the IPCC report. I know quite well the last one on investments and finance, and there are 2 main messages. The first is that financial institutions are not there yet in doing a proper climate financial risk assessment. But the second message, and this is linked to the other question that was asked, is that credible climate policies for restructuring the economies are not there yet. And this is a major barrier for any financial risk assessment, because if I am an investor and I do stress tests. So stress tests are not new. I mean, they have been done since the last financial crisis, both by financial institutions and regulators. And when you do stress tests, also addressing the question on uncertainty, you work with scenarios. So everything is forward-looking, and you embed the uncertainty working with a lot of scenarios. So actually, this is what should be done. Lawyers are right to get worried, but financial supervisors already did what they could do. I mean, there is always something that could be done better. I mean, we discussed it before with the models. But the problem now is that actually the point is governments should act, introduce credible and early climate policies. And policies could not be, if it wants to be credible, and influence investment decision by a financial risk assessment that we will do carbon capture storage in 30 years. So we need credible climate policies now. Otherwise, I mean, why investors should adapt their financial risk assessment?
Thank you. So we need to close and march over to the debate. So one final thought from our other speakers. Olivier?
Not much to add. Just to go back to the point I made before. I mean, those issues are even more challenging in less advanced economies where the data may be missing. So really focusing on the process to engage with the client, to focus on the materiality of the risks, the heterogeneity to be taken into account, and the uncertainty, I think, is quite important indeed.
Thanks. Yeah, I think for me, just to say, data is knowledge, knowledge is power, and with power comes responsibility. Whenever we're using model output, we should be communicating it with the appropriate context, and the way we communicate that is really important. So, yeah, that's what I would leave on.
We're out of time. I'm just going to say that I think the adaptation finance side of things is a solution. So we are running out of time on the physical risk side. There's tipping points, there's uncertainties, ocean warming, heat currents, Gulf Stream and all that. Who knows what will happen, but it's probably not going to look very good. So as we invest all of our wealth and money into the transition side, as a society, as we start thinking about financial instruments and adaptation investment more in general, that can probably be a robust response, resilience and transition at the same time.
Thank you. Great final message. Well, thank you all, and let's thank our panel.